They signaled it strongly and it was widely expected. I'm talking, of course, about the BSP once again cutting key interest rates by 25 basis points for the third time this year. That places the benchmark rate at 4%. Overnight deposit rate has also been slashed to 3.5%, as well as lending that's now at 4.5%. Reserve requirement is still at 16%, though recall that BSP Chief Bangko announced that this could be cut further in any of the next weekly meetings until year end. The central bank likewise cut its inflation forecast for the year to 2.5% while retaining forecasts until 2021 at 2.9%. The Monetary Board, though, noted that there are upside inflation risks for 2020.
Now, the upside risks to inflation over the near term emanate mainly from volatility in oil prices due to the geopolitical tensions in the Middle East, and from the potential impact of the African swine fever outbreak on food prices. Meanwhile, the subdued pace of global economic activity continues to temper the inflation outlook.
The BSP's decision comes amid easing price pressures and government's move to rev up economy after disappointing first-half growth figures. But while the move was widely expected, the question now becomes, will we see more cuts this year? As usual, the BSP said it would be data-dependent and would not commit to anything. But they did point out the particular data that they're watching.
In particular, we'll be looking at updates to the World Economic Outlook of the IMF. And so we'd have a better insight on the emerging risks to global economic activity. And also we'll be waiting for the release of the third quarter's GDP data.
Another thing that the BSP is watching out for is oil, which has been a source of volatility of late. The BSP maintains that the risk to oil prices remains short-term and won't have a lasting impact.
While there's still uncertainty in the global oil market, I think at least the market consensus seems to be that the supply is slowly recovering. Any sort of shortfall resulting from, let's say, disruptions in oil production can be covered quickly, which is why we've seen a bit of some easing in global oil prices as well, and that's reflected in the latest forecasts.